Hello, I'm Bernard Hickey from interest.co.nz and welcome to a special housing report brought to you in association with BNZ. Today we look at housing lending figures. This is important for the housing market and for the economy overall because, remember, we're not so much an economy but a housing market with bits tacked on, although that is changing. And now we can see with these latest figures on house lending that we're really grinding to a halt in the house lending market. When you look at the numbers of new loans issued in June and how much extra was lent to the household sector, we hit a record low, down to $112 million extra lent to households in the form of mortgages. This was the lowest monthly rise since 1998 when the Reserve Bank started taking the figures in this way. Got to remember that overall home lending is up to $169 billion. And the average extra added every month over that period since 1998 was about 800 million every month. And now we're down to 112 million in the month of June. Also, to give you an idea of how much of a difference that is, at the peak of the boom in 2007, the banks were lending an extra $1.5 billion a month. And now we're down to a tenth of that, in fact, less than a tenth of that. That gives you an idea of the amount of credit that's not being pumped into the housing market and into the economy. Essentially, New Zealanders are going cold turkey on extra mortgage debt. And it's not just mortgage debt. When you look at what's happening with consumer debt as well, when we say consumer debt, we're talking about consumer loans, hire purchases, car loans, those sorts of things. They're actually falling. And they've fallen from a peak of just on 12.7 billion in December 2008, and that's a crucial period. Remember that last quarter of 2008 was when the global financial crisis was at its worst. It's fallen consumer debt from 12.7 million then to about 11.9 billion now. Not only are people slowing the growth in debt, in fact they're reducing it in nominal terms. That's quite something given that incomes are still rising and of course we still have inflation. What's this all about? Why have we stopped borrowing money? It's not just a matter of the banks being a bit more cautious. There's this demand side here as well as a supply side. I'm calling this the big squeeze. It's not so much the big freeze, because that implies that the banks have stopped lending. It's actually a squeeze on household debt levels. We essentially have reached debt saturation point. And it's quite easy to look at where that debt saturation point is. What is the threshold? When do we know we're choking with debt? Well, when you look at this chart, you can see that household debt as a percentage of disposable income in New Zealand hit a peak of about 159%, again in that last quarter of 2008, up to 159%. It's actually been falling since then as we increase debt at a slower rate than we increase incomes. And when you look at the increase in the debt in June, it was about 2.8% or so. That's actually in line with, or maybe even slightly slower than nominal wage growth. So, what happens here in the rest of the economy? Well, when you look at lending to the agriculture sector and the business sector, it's not that much more attractive. When you look at ag lending, that topped out at about $47.3 billion. We saw a little bit more in June because it's that time of the year when farmers borrow a bit more for winter feed and that sort of things. And in fact, the increase was $228 million for June, twice as much that was lent to the housing sector. But when you look at what's happening in ag lending, that is slowing to a near halt as well. And remember, it's come a long way. Ag lending about $47.3 billion. That's up from $12.5 billion 10 years ago. So the agricultural sector is hitting that debt saturation point as well. So what happens from here? Well, given that banks are being a lot more cautious about their lending and people who are borrowing are being a lot more cautious about their borrowing, you'd have to say the injection of debt into the consumer economy, into retailing, into the housing market, into the farming market, particularly for land sales, it's just not there. That suggests either prices are going to fall or at least be stable for some time. And it shows that New Zealand can't rely on that extra debt to keep its economy pumping along. We actually have to earn our way, increase our exports, increase our production, and we are starting to see that. But it's going to be a long grind out of this because, again, we've hit debt saturation point. I'm Bernard Hickey. That was a special housing report on the big squeeze brought to you in association with BNZ.